You've probably heard that TCJA expired at the end of 2025 and that your tax rates just snapped back up. That's the story that's been circulating in retirement planning circles for the last 2 years. And I understand why people believed it. The sunset date was real, the anxiety was real. The story turned out to be wrong. And if you've been making decisions based on it, your plan needs a correction right now. The One Big Beautiful Bill Act, that's PL 11921, signed July 4th, 2025, permanently extended the 7-bracket structure before the clock ran out. The 39.6% top rate is canceled, permanently. So, where does that leave you if you're 55 and trying to catch up? That's exactly what I want to work through, because the math changed in ways that actually help late starters. And there are windows in the new law that close long before most people realize they exist. Let me start with what's actually sitting on your 2026 return, because the numbers have shifted more than most people realize. The 7 federal income tax brackets, 10%, 12%, 22%, 24%, 32%, 35%, and 37%, are now permanent law, not extended temporarily, not subject to another sunset fight in 2029. Permanent. The IRS published the 2026 inflation-adjusted figures in Revenue Procedure 2025-32 back in October 2025. And the top bracket of 37% now kicks in at $640,600 for single filers and $768,700 for married filing jointly. If you're nowhere near those numbers, great, but the bracket boundaries below them matter a lot for conversion math, which I'll get to in a minute. The standard deduction is also permanent, and it's larger than it was under pre-TCJA law. For 2026, it's $32,200 if you're married filing jointly. That's up $2,200 from 2025. Single filers get $16,100, up $1,100. The IRS inflation adjustment for 2026 and 2026 ran about 2.7% across most parameters. Roughly 87% of taxpayers still take the standard deduction rather than itemize, and that's not changing. The PEAS limitation, the one that used to phase out itemized deductions for higher earners, didn't come back. Personal exemptions didn't come back either. What you see is what you've got, and honestly, for most people in their 50s and early 60s with a paid-off or nearly paid-off house, that standard deduction is the whole game. One thing I want to flag that I don't see discussed nearly enough. If you've been withholding or making estimated tax payments based on the assumption that your 2026 rate would be higher, say, because someone told you the 25% bracket was coming back and bumped up your withholding, check that now. Seriously, pull your most recent pay stub or your last Form 1040 ES worksheet and recalculate against the actual 2026 brackets. Over-withholding isn't a disaster, but you're giving the IRS an interest-free loan, and right now every dollar matters for building your base. Now, here's where the thinking has to shift. For the past 2 or 3 years, the urgency argument for Roth conversions was almost entirely legislative. Convert now before rates go up when TCJA expires. That argument evaporated on July 4th, 2025. But, and I want to be direct here, the case for converting to Roth didn't disappear. The reason changed. My take is this. The most powerful Roth conversion window for a late starter was never really about TCJA. It's structural. It's about the gap between when you retire and when required minimum distributions force income on you, whether you want it or not. If you retire at 62 and your RMDs start at 73, that's an 11-year window where you potentially control your taxable income to a degree you'll never have again. No W-2 wages, Social Security may be deferred or partially deferred, and a traditional IRA or 401k sitting there compounding and growing the future RMD you'll owe taxes on. Converting deliberately, not frantically, not chasing a deadline during those low-income years is sound math. The goal is to pay 12% or 22% now instead of 24% or higher later when RMDs pile on top of Social Security and potentially push Medicare premiums up. Speaking of which, I'm covering exactly how IRMAA and Medicare premium surcharges interact with this strategy next week. That's a separate video, and it's one you don't want to miss. The conversion amount that makes sense varies significantly based on your filing status, your projected RMDs, and whether your Social Security is already in the mix. There's no universal answer, but the right framing has changed. You're not racing a legislative clock anymore. You're managing a lifetime tax bracket, and you've got more time to be methodical about it. Now let me tell you about something that's genuinely new and genuinely underreported, because this is the piece I spend my days digging into. The rules retirees actually have to live with, not the ones that get the headlines. Section 70103 of the One Big Beautiful Bill Act created a brand new $6,000 bonus deduction for taxpayers who are 65 or older. If you're married, filing jointly, and both spouses are 65 or older, that's $12,000. It's available for tax years 2025 through 2028, 4 years, and then it goes away. This is not the existing over 65 standard deduction add-on that's been around for decades. That's separate. This is stacked on top. So let me show you what that actually looks like for a single filer who's 66 years old in 2026. You start with the $16,100 standard deduction. Add the age 65 or older additional standard deduction, IRS pegs that at $2,050 for single filers in 2026. Then add the new $6,000 OBBA bonus. That's $24,150 of income that's simply not taxed at all for 4 years. The phase-out on the $6,000 bonus starts at $75,000 of modified adjusted gross income for single filers and $150,000 for married filing jointly, and it reduces at 6 cents for every dollar above those thresholds. A single filer with $100,000 in Magi, for example, loses $1,500 of the deduction. They still get $4,500 of it. At $175,000 for single filers, it's fully phased out. Here's what this means for conversion planning specifically. If you're 65 to 68 in the years 2025 through 2028, that triple stack deduction effectively widens the room in your lower brackets before a Roth conversion pushes you up. The right move, in my view, is to model this against your projected 2026 income right now, not in December, and figure out whether you have headroom to convert in the 12% or 22% bracket before you'd hit the phase-out floor. That's a conversation worth having with a fiduciary who can run the actual numbers for your situation, because the filing status and Magi calculation matters a lot here. The catch-up contribution rules are where things got genuinely complicated starting January 1st, 2026, and I want to make sure you understand what changed. The standard 401k contribution limit for 2026 is $24,500. Workers 50 and older can add a catch-up contribution of $8,000 for a total of $32,500. Those are the baseline numbers. But if you're between ages 60 and 63, specifically 60, 61, 62, or 63, Secure 2.0 created what the IRS calls a super catch-up. Instead of $8,000, you can contribute $11,250 in catch-up contributions for a total 401k contribution of $35,750. That's a meaningful difference, $2,750 more per year than what your colleagues turning 64 can put in. On the IRA side, the 2026 contribution limit rose to $7,500, and the age 50 catch-up for IRAs is $1,100 for a total of $8,600. That's different from the 401k catch-up structure. IRAs have their own math. Now, the mandatory Roth catch-up rule. This one is confusing, and I've seen it written about in ways that make it sound like a penalty. It's not. Starting January 1st, 2026. Per IRS Notice 2025-67 and the final Secure 2.0 regulations finalized September 16, 2025, if you're 50 or older and you earned more than $145,000 in FICA wages in 2025, your 401k catch-up contributions in 2026 must go in as Roth contributions, after tax, not pre-tax. Here's the reframe that most coverage misses. If you're a higher earner who's been locked out of direct Roth IRA contributions because of income phase-outs, this mandatory rule is actually opening a Roth savings channel for you. You're being pushed into Roth on the catch-up portion, up to $8,000 or $11,250 if you're in the super catch-up band, and that money grows tax-free. The irritating part is the payroll system complexity, and some plans are still catching up administratively, so check with your HR or plan administrator now to confirm your 2026 elections are set up correctly. Don't assume the system handled it automatically. The practical withholding adjustment piece is the one that's most time-sensitive right now, so let me end on this. If you're still working, your 2026 withholding is based on a W-4. You may have filed a year or two ago. potentially under assumptions about your 2026 tax rate that are now wrong. With the brackets confirmed permanent at the 2026 levels published in Reverend Proc 2025-32, and with potentially new deductions available to you if you're 65 or older, your effective tax rate may be lower than your current withholding reflects. The IRS Tax Withholding Estimator is the right starting point. It's free, it takes about 20 minutes, and it'll tell you whether you're on track or whether you've been accidentally over-withholding all year. If you're retired and drawing from accounts, traditional IRA distributions, 401k distributions, or both, you're likely making estimated quarterly payments. The same logic applies. Rerun the numbers against the actual 2026 bracket thresholds, factor in the senior bonus deduction if you qualify, and adjust your Q3 and Q4 estimated payments if the earlier quarters were based on stale assumptions. Underpayment penalties kick in when you owe more than $1,000 at filing and haven't paid at least 90% of the current year's tax or 100% of last year's liability. So this isn't purely academic. The SALT cap, briefly, for 2026, the deduction cap on state and local taxes rose to $40,400, up from $40,000 in 2025, indexed at 1% per year through 2029, and then reverting to $10,000 in 2030. If you're in a high-tax state, this is worth revisiting whether itemizing makes sense again, though with a $32,200 standard deduction for married filers, the bar to beat it is higher than it used to be. The SALT increase phases out for very high earners, starting at $505,000 MAGI in 2026. So for most people in this audience, it's a clean number. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If anything in here prompted a question I didn't answer, about RMDs, about Social Security timing alongside conversions, about how your specific state taxes interact with any of this, drop it in the comments. I read them, and the questions I see most often shape what I cover next. Subscribe if you haven't already, and next week I'm walking through Medicare's IRMAA surcharges, the income-related premium adjustment that can quietly add hundreds of dollars a month to your Medicare bill once your income crosses $103,000. It catches people off guard in the first year of Roth conversions especially, and it's worth understanding before you pull the trigger on anything. See you then.